There's a group of ETFs right now paying 20%, 30%, even 50% income. And when I ran the actual numbers, some of them looked like the worst performers. But when I looked at them in a different way, they jumped to the top. So I tested 10 of the most popular income ETFs using two simple metrics: yield and price growth since inception. No projections, no opinions, just what they've actually done. And what I found completely changes how you should think about high yield investing. So stay tuned. Welcome back to Simply Money. So today we're going to be looking at 10 high income ETFs. We're going to be looking at both the yield and the appreciation. We're going to see how that would perform over long term and projecting them forward. But we have to remember, past performance does not guarantee future performance. And so we're just taking the past data. That's all we have to go by. And we're making those assumptions going forward. And we're going to share some of those things and what they could be doing for you. You need to stay tuned as we look at this throughout till the end, and we play a couple different scenarios so you can see how it could impact you. And remember, this is not financial advice. This is for informational and educational purposes only. We're going to dive into our spreadsheet right here. And what we have to begin with is this is the Simply Money Portfolio Planner. If you like this and you'd like to get a copy, they are available at Buy Me a Coffee down below in the link in the description below. All our spreadsheets are there, and I appreciate all of you that support us that way. What we're using the spreadsheet here today for is we've picked our 10 tickers. We're going to look at those here in a moment. And in this drop down, you can pick any ticker you want. I have a whole bunch of them listed here, about 150. And we can add more if you buy this and you want some on there. Just let me know, and I can add those for you. What we're going to do is we're going to put them all in the conservative portfolio. This has nothing to do with conservative, moderate, or aggressive. But what I'm doing is I'm putting 10% in each one because we're going to start with $1 million. And before you get all bent out of shape, like, wait a minute, nobody has $1 million or very few people have $1 million, make a video that's more applicable to everybody. Why we're doing this on this video is that the $1 million is going to be split 10 ways. So each of these funds will have $100,000 in a beginning portfolio. We're also going to look at it here later in the video where we start with zero and we add monthly to see how they do compared to one another in that manner. We're going to look at a couple different scenarios doing this, but the first scenario we're doing is if we invested $100,000 in each one of these funds, what would they have done if past performance continued over 10 or 20 years? And we're going to look at that and we'll discuss that as we move into that. That's how we're doing this. Don't think, oh, he's doing $1 million portfolio, I'm going to check out. Now, what we're going to do on this one is we're accumulating right here for 20 years, and that's all I had to do on this sheet, and I can run these forecasts. We're going to go over here to the Forecast Pro on this one because I want you to be able to see what it's doing from each of the individual funds and the total of the portfolio. So over here on the Forecast Pro, we have the portfolio total, which I said is $1 million, but we're starting out $100,000 in each of these funds. And our funds that we're competing here, we have SCHD, DIVO, JEPI, JEPQ, SPYI, QQQI, CHPY, QDTE, XDTE, and TSLY. Those are our 10 funds that are competing today to see how they do in different scenarios. The first scenario is strictly we invest a lump sum of $100,000. All distributions are reinvested, and we're going to look at 10 and 20 years and see what happens. We come down here to the end of year 10, we see SCHD at 329, DIVO at 262, JEPI 285, JEPQ 344, SPYI 373, QQQI 591. Don't get too bent out of shape on this one. CHPY 8 million, and I'm going to explain this here in a moment with a couple of these, so don't go freaking out yet. Leave me a comment. What's your first impression of that? I will explain why this seems way off in a moment. QDTE we'll say 2 million, XDTE 820,000, and TSLY 381,000. Let me start with CHPY, because people are going to say, wait a minute, how are all these others at so much lower? And why is that so outrageously high in 10 years? Two reasons. CHPY's only been around a year. That's the only data we have to go by. I have two options. When we do back testing, the data is what it is. What it did over the past, whenever we start to wherever we go to, that is the data, and it is actual what happened. But when we project forward, we can do either one of two things. We can take past data, take the annual averages, or we can estimate what they will be based on other factors. Like CHPY is in the semiconductor field. We can look and see what are other semiconductor companies and stocks doing. If they have a longer track record, what are their projections? And so we can formulate maybe what we anticipate the average to be, because I'm going to tell you, I love CHPY. I own CHPY, and I'm excited about what it's done. And I still believe the semiconductor realm is going to be strong for, I believe, in my opinion, for several more years, maybe longer. I don't know. Maybe it'll die out quicker. But I can almost guarantee you, and there's no guarantees, I can almost guarantee you that it's not going to maintain what it's done this initial year. This year has been phenomenal for CHPY. It's paying out almost 30% yield, and its appreciation has been over 30%. Its total return has been ridiculously high over this past year. In this number, I actually toned it down a little, and it's not even close to what it will probably be in the future over a 10, 20-year period. It's not going to sustain this for 10, 20 years. It's like taking NVIDIA over the last 5 years and thinking that's going to happen for 30 years. Or taking Apple during its peak, or other companies during super bull markets and thinking that's going to sustain. They're going to have bear markets. CHPY's going to have probably higher than average, higher than beta of 1 down markets, where the bear market will get a hold of it and it will drop significantly more than the S&P 500. But I put this in, and I wanted to do this because I want people to see what it has done, to see how that impacts the future. Now, we will change that to be more realistic of what it should do over long terms. Again, we're going to come down to 20 years. I hope that makes sense. And there's no way for, even with SCHD, we're using 15 years of data to show its averages. But over 30 years, it may not keep those same averages. It may be lower, it could be higher. We don't know. Again, there's no perfect way to do future projections, but we're doing what we have based on past. The data that I have in here is strictly from inception. It's averages. It is what it is. And I wanted to show that. And there's a reason we're going to look at that here in a moment again, but I want to look at right here, year 20. And again, CHPY, we're just ridiculous now. So you can see how ridiculous that gets. Everybody would be in this if this would actually sustain. Think about that. $100,000 turning into almost $670 million in 20 years. It's just not even fathomable. It's not even realistic. But I put it in there for you to see how off data can be if you're only using past data that has a short window, because it's had a great bull market. It can be the same way in a market on a fund that maybe it's only been around a year and it got picked up right when that sector took a big dive. For instance, if you're looking at some of the crypto ETFs, if you pick those up back in July or August of 2025, you may be watching those decline. And if you're only using data from a year and it's been in a really bad downturn, you're getting a false perception that, oh, this is just losing value, which it is currently, but over a course of 5, 10, 20 years, that could flip, and those averages tend to work out. That's why your growth funds, your hyper growth funds, high tech stuff, you can look at 17, 18% returns over long-term periods. That's not unheard of. And then your S&P 500 and funds similar to that, you can be looking at the 12, 14% total returns. And those, again, not unheard of over long term. Then more value funds, you're typically looking at 7, 8, 9% over long term. But when you take small segments of time, that's where data gets very misleading for people, and we need to keep that in mind. I have Chippy in here for you to see how absurd that can be. But let's look at some of these others. SCHD at 1.1, DIVO at 700,000, JEPI at 823, JEPQ at 1.2 million, SPYI at 1.4 million, QQQI at 3.5 million. And so as we look at these, you can see even QDTE has this extremely high that is extremely unlikely. Obviously not as absurd as Chippy, but it's still extremely unlikely that it's going to maintain that for 20 years. We have to consider that, and that's one of the things that when I made my evaluation of these funds, I took in consideration. With that being said, I want to go back to the portfolio. We're going to keep it at $100,000 each, but we're going to do something a little different. We're going to pretend that you're looking to use the money, the income now. Perhaps you're at retirement and you put $100,000 into a particular fund. How would it do if you're taking all of the distributions? Now, remember, some of them are going to provide a much higher distribution and a much higher income than others, but how does your portfolio fare over that time? We come to accumulation years and we put that at 0. All income is now being taken instead of being reinvested. And we want to go back to Forecast Pro. And again, we started at the $100,000 each. You come over here and you can see the income generated. Now, this is one of the limitations of this portfolio provider here. You cannot see each individual fund's income. This is the total portfolio. If you wanted to do that, you'd have to run one at a time. You could do 100% in SCHD, then 100% in DIVO, etc., to see what kind of income you'd get from each of those, and only put $100,000 over here. But we're doing all of them together just to see what the end balance would be with you taking the income. At the end of 10 years, with taking the income from these funds, you can see right here, SCHD, out of all of these, again, Chippy aside, SCHD maintained and over doubled its value while paying out its distribution. We have DIVO with 162, JEPI with 121, JEPQ with 134, SPYI with 121. QQQI here is 162, and remember, they're paying about 14%, so your income from that's going to be much greater. Chippy, 900,000, and getting the income, again, not realistic, not sustainable. We'll change that here in a minute. You got QDTE at 60,000, XDTE at 60,000, and look at TSLY. After 10 years, you're almost out of money because you're getting that high, ultra high dividend, but you're also losing value. Now, again, some people, and I get this, and we're not doing every possible scenario here. I'm just showing if you did not reinvest at all. A lot of people with TSLY would take some of the distribution and then reinvest some of it to maintain or to grow that balance. And that would be what I would suggest. But that's something you have to do with these high yielding funds that also have price depreciation. With something like SCHD, you're not getting that high income, but you're growing your portfolio. You have your more moderate kind of middle ground from JEPI to QQQI, your 9 to 14% income, and with slight upside. You're slowly growing your portfolio, but you're getting a much steadier, higher income. A lot of different things to look at. I personally, in my portfolio, like a balance. I like some that it's a little bit higher income, a little bit, some that's just all growth. I have some like SCHD that's a combination of very moderate income, but strong income growth and some growth. So it gets a combination of those, and obviously different sectors and different funds with different risk tolerances on all of those. At the end of 20 years, with taking all the distribution out of these funds, look where you're at. 556,000 with SCHD, and you're down to $190 with TSLY. You're probably not getting much of an income over these last 10 years because you went from $4,000 to $190 because your yield is based on what's in there. If you're taking money out and you're not reinvesting some to maintain that balance, your income's going to go down. Or something like SCHD, you can take all of the income and the dividends growing while you're growing your portfolio. So you get a double pay raise while taking the income, or you can do some mix and combination of those. Those are a couple different scenarios we can look at. Now, the third one I want you to look at, and this is where it gets interesting. So stay tuned here. We're going to go to a zero portfolio. We're going to start because this is where we all started. We all, unless you inherited some money, we all started with zero. We all had to build our portfolio. So I wanted to do this because a lot of people are like, hey, I'm starting from zero. What would it look like if I was just dollar cost averaging in? We set the portfolio value at zero, accumulation to 20 years. We have to come over here to deposit rules. We're going to say we're going to deposit $500 a month. And you can do any which way you want. You can do $100 a month, $5,000 a month. I'm doing $500 a month. We're starting on month one where we're doing this, and we're doing that for 30 years, 360 months. And how that 500 is going to be distributed is 10% is going to go into each of these funds. So you'll get to see how much it would accumulate, the same amount being invested, and then all of the distributions being reinvested. How does it grow from zero? We're going to come back to the Forecast Pro, come up here to the year one. You can see we're zeroed out. And the first month, we got $50 into each of those because we put the $500. And we come over here. You can see the income generated is zero. We haven't generated any income. You can see how the income grows slowly. We'll just look at the end of year one. $500 a month is $6,000 in a year, and then you're generating about $79 per month. Not a ton of income. And this is part of the growing of a portfolio. It's slow. It seems like nothing's happening. Whether you're, a gardener and you start planting seeds and you're like watering and tilling and nothing's happening, then all of a sudden it just shoots up and you start seeing the production. And the more you take care of it and prune it, the more production you get. And that's the same way with investing. The more you invest and stay consistent and maintain it, you will see that growth. Let's come down to the end of year 10. By starting at zero, investing $500 a month, you can see we're pretty even across here. Again, JEPI just takes off because of the current condition that it's in. And after 10 years, you're looking at from 11,000 here, QDTE up to 25,000, TSLY 12,000. They're all growing at different rates. They're all reinvesting those distributions. And if you're doing that, can be a very strong way to add income growth because you're adding more shares. And as that share price is dropping, you're getting even more shares. And so there's a lot to be said about income investing. And it's just something for a lot of people. You have to be careful and know what you're doing and be able to tolerate the swings. They're very high, very volatile funds. As we come to the year 20, the end of year 20, see the growth factor. Again, $500 a month for 20 years is not going to grow to almost $9 million. I can just tell you, it's not going to happen unless you happen to hit that 1 in a million chance. It's like almost like playing the lottery. And I'm not saying don't invest in JEPI. I'm not saying to invest in it. I'm just saying don't have your expectations that that's what it's going to do. The likelihood of that are very, very, very low. But the others, you can see the change. You can see the growth in those. And you can see how over time that works. Now, what I want to do on this one is I want to come down actually to the end of 30 years because we ran this for 30 years. And this is geared more for our younger folks. Maybe you're in your 20s, 30s, even your 40s. And you're like, I want to start and I have 30 years until I'm going to need it. What will it do? And let's just pretend, JEPI aside, you invested in this. Look at what you're going to be seeing at the end of year 30. You're looking at 126,000 in SCHD, 67,000 in DIVO, 56 in JEPI. And this is nothing incredible, but it's just showing the steady growth that's available. Look at this with QQQI, 194,000, QDTE, 210, XDTE, 117. And a lot of people are going to come to the end here where I'm about to reveal my picks. And they're going to say, why would you pick that when you have, even if JEPI doesn't come close to this, look what it's done. Or look at QDTE and what it's done. Why are you picking the ones you're picking, and what's the madness behind it? To me, it's obvious. And again, this is me because my tolerance, my situation, where I'm at, and what I do. If I was going to pick three, I would pick SCHD because it's a steady income, it's growing its income, and it has a proven 9% growth rate. I would pick that. And as you know, that follow my channel, I do have a very heavy position in SCHD. And when the market is down, SCHD is very low volatility and doesn't drop to the same level as the market. Now, for more aggressive in a portion of my portfolio, I have Chippy. I have bit of money in here because it's showing right now a 25%, over 25% growth and paying a steady income. And I have another video I'll be doing with my monthly update showing how my income is growing month over month, week over week with Chippy, because it also pays weekly compared to SCHD, which is quarterly. And then I would pick a combination of maybe QQQI and DIVO, which has the 5% growth. Now, and again, this isn't, I'm saying do this or that. I'm just showing you why I would pick these because I like the steady growth with income. Now you have others, and I have most of these as well. I have JEPI, I'm sorry, I have JEPQ and I have SPYI. And those have the 2 to 3% growth while giving 9 to 12% income. So I like those. They're income providers and providing those dividends, producing great monthly income for me. And believe it or not, I would put QDTE, XDTE, and TSLY down at the bottom. I'm not a fan of them. Others may be like, you are crazy, dude. You should definitely get into that. If you think I'm crazy and I should be in those, leave your comments down below why you think that. Don't just say I'm an idiot. You can say that too. I get that a lot. That's fine. But tell me why. What's your rationale behind it? What's your reasoning? Why do you think QDTE or XDTE or even something like Tesla that's had a negative 27% price depreciation? Why would you want to own that? Tell me. Give me an explanation. Don't just say because it's great. Give me your reasoning. And do you own it? How long have you held it? Are you in the red? Are you in the black still? And I'd be curious on that. That's based on price alone, the reason why I would choose the ones that I did there. But if you're going to look at another way here, the data shows something different. If you're including the yield, because yield is not small here, yet 25% from Chippy, 30 to 35% from XDTE and QDTE, and 55% from TSLY. There is where everything flips. Total return 30% for QDTE, 25% for XDTE, and Chippy. Again, unsustainable, but has done this 50% total return. But again, in my opinion, bottom line is based on price, I'm going with SCHD, Chippy, QQQI. Based on total return, I'd go with Chippy, QDTE, and XDTE. But be prepared for some major pullbacks. The exact same ETF can go from near the bottom to near the top just based on one decision. And what's the real decision? If you don't reinvest, price growth drives your outcome. If you do reinvest, yield can drive your outcome. And that can completely change the rankings. List down below what is your ranking on these 10. How would you rank it? And is it based on that you're dripping or not dripping? Leave that for the community below. There's a lot of information here, a lot of decisions. If you're looking at any of these that you need to make, please do your own due diligence. Again, this is for educational and informational purposes only. That's our video for today. Thank you for joining me, and we'll see you next time on Simply Money.